Welcome to OK Computer. I'm Dan Nathan. I am joined by Gene Munster. He's the managing partner at Deepwater Asset Management. Gene, welcome back to the pod.
Great to be back.
All right. You know I look forward to this every quarter. Actually, I think we're doing it more than every quarter, or at least once a quarter.
Yeah, my life is better. I couldn't quite put a finger on it, but I think you just nailed it.
I think we're usually doing a preview, and then we're doing a review of big tech earnings. And, it's interesting that we have plenty to talk about today because, tomorrow, this will be Tuesday. By the time you're listening to this, we get kind of mega cap tech earnings kicked off with Tesla. We did have Netflix last week and the reaction to that. So we definitely want to talk a little bit about that. I know that you've been also talking about, just the implications of a potential ban of TikTok here in the U.S. Now, again, that's a potential ban. We know that this is going to take a very long time if it were to play out. But what are the implications on Snap, on Meta, and some other names in the space? And then we're going to obviously get to Apple and Amazon and the Google and a few other names here. But really quickly, as our team was doing a little work for this pod, they noticed on the Twitter that you're doing a weekly video, Deep Tech 315. Give us the 411 on DT315. What are you doing? When's it drop? And what are the goals there?
So it's myself and Doug Clinton, who's one of the other founding partners at Deepwater. Doug and I have worked together for 15 years, covering investing in big tech. And so what we do with Deep Tech is we highlight this is the 3 and 315. We highlight 3 topics in the week that are the 3 most important topics, and we do it all in 15 minutes or less. And so, said another way, if you happen to be checked out for 4 days, what's going on in tech, check into Deep Tech 315 on Friday morning, and we'll get you up to speed.
Awesome. All right. Well, you can follow Gene Munster at Munster_Gene because that's where that video also drops. And then I also noticed, Gene, that you're doing some really great, longer form tweets. This is away from that 140 character sort of situation, breaking down things real time. I know that we get the benefit of you on Fast Money joining us, at 5 o'clock on CNBC when a lot of this news is breaking. But there's a lot of great stuff on your Twitter account. All right. So be sure to follow that. Let's talk a little bit about the reaction in the market on Friday to Netflix's earnings results. It's interesting, Gene, as that stuff was crossing the wires, the quarter looked good. The guidance didn't look all that bad. It seemed like a lot of folks were kind of up in arms about the change in reporting. That's not going to happen for a few months or so. What was your first reaction? Because as you were on talking about it, I had another very prominent analyst on the sell side. He was texting me saying, this just reeks of hubris. It's just, all that sort of stuff. And I just thought that was kind of really interesting. I feel like a change of reporting metrics is one thing if it's in really short order, but this was quarters out, and it was getting analysts or investors plenty of time to get their arms around this. And obviously it speaks to the maturity of this business and the like here. And listen, this is a company that has had a lot of volatility in and around their subscribers. Usually it seems like every 2 quarters we have some sort of situation. Just what were your quick thoughts here? And did it change your mind on the story at all?
So going into the print, I was negative, and that was just kind of based on before we happen to be joining CNBC, and we send our notes before what we expect. And my first sentence was negative going into the quarter. When I saw the subscriber number 10 million, call it, and the street was at 4.5, I thought this stock is going to scream higher. And the reason why I was negative going into it, and the reason why I think the stock traded off, was a little bit related to that change in accounting. I think it was more related to investors taking a step back and saying, this was an awesome quarter, but this might be the peak quarter that we have in terms of upside surprise over the next 3 or 4 quarters. And the reason, of course, is the nice benefit that they've had and the stock has responded appropriately over the last year based on, of course, the password crackdown and the ad model. And so they've mentioned on their earnings interview that they see several more quarters where they get a benefit to that. But as soon as they said that in the after hours trading, the stock started drifting lower. And part of the reason is that when you say several, when you even identify that there's an endpoint to that benefit, then I think investors start wondering what's the upside. And then you put into that mix, of course. I think they did it right. If I'm them, I don't want to be held accountable to that subscriber number, because ultimately it matters more about revenue than subscriber numbers. So all of that's great, but I think the core underlying issue is just this sense that we're not going to see the kind of upside because they've had this nice tailwind.
Yeah, and I guess the way I was thinking about it that night, I didn't have much of a view heading into it, and again, stocks like this that have huge runs into earnings, especially from their last quarter, you saw that gap from $500, up to, 600 almost, in the week after that last print, and it kept on going. I'm saying to myself, like a lot of good stuff is kind of worked into the stock, but then I look at it here, and you talk about that kind of revenue, that at some point you're gonna like kind of that benefit trails off a little bit. I'm looking at like 15% expected revenue growth this year, 12% next year, but most importantly, 41.5% gross margins last year, expected to be 44.5% this year, and maybe as high as 46% next year, right? And I say to myself, trading 30 times this year, 25 times next, this is probably still a pretty good story if the crackdown on passwords, if the ad-supported stuff leads to higher margins, you know what I mean? Because these are some of the highest margins you've probably seen in Netflix in a very, very long time. So to me, let's see. I think the stock's probably going back to fill in that gap at 500 from last January. But at that point, if there's not a material guide down, you know what I mean? It's probably a pretty decent do down there. That's my kind of 2 cents. Does that make some sense to you?
Makes sense. I think one of the other advantages of Netflix, it's an easy one for people to be lukewarm on, to be kind of negative on, just because it doesn't have the excitement around AI that a lot of the other big companies have. And so a lot of times, of course, the markets will do the exact opposite. So I think you don't have the FOMO risk in owning Netflix here. That would be the upside. My general sense, I'm in agreement with that. I think there are just better companies to invest in.
Yeah, no, that makes perfect sense. And, all the time, I mean, we obsess over the same names over and over again. I say we, like some pundits, some of the folks that, have pods and the like here, but largely because these largest stocks are huge, EPS contributors to the S&P 500 and huge weightings in those indices. So if you're trying to do like a top down and then a bottoms up, you kind of find yourself at these top 10 names, and again, Netflix is not one of them. It was a $275 billion market cap company. And it's kind of interesting because now we only talk about companies that have trillions of dollars in market cap every day, at least.
Mere hundreds of billions.
Yeah, exactly. Mere hundreds of billions. Let's talk about Tesla. Reports tomorrow, Tuesday, after the close. The implied move in the options market is getting up there, high single digits. And I think it's important to remember, over the last 4 quarters, this stock has averaged a 10% decline. Okay, so when the company has come out and they've given their earnings and their guidance, the next day, the stock has dropped about 10% over the last 4 quarters. Now, we already know deliveries by the time that this company reports earnings, and we know the deliveries for Q1. You had a nice conversation with Doug on Deep Tech 315 last Friday talking about this situation. I mean, the sentiment couldn't be worse. As we're taping this Monday afternoon, the NASDAQ is up, nearly 1.5%. The S&P is up 1%. We know that Friday was a very bad day. Tesla closed horribly, but again, this is one of the only stocks on my screen that is down on the day. It's down 3%. It was down 5%. It seems like every story that comes out in the news about this company, no matter whether it's about Elon, whether it's about his pay package, whether it's about deliveries, whether it's about competition in China, the Cybertruck, price cuts. Again, the list goes on. At full self-driving, the list goes on and on and on. There's not a single good thing you hear about this story. What is your take into the print? Because I cannot remember a more negative setup for a stock in a very long time into a print.
Well, I think it's first, I just like to roll the clock back 3 weeks ago. You and I were discussing Tesla after their deliveries had just come out. The stock was, I think, around 170, 180 in the aftermarket. And your comment was, I can see this stock going a lot lower. I think you might have even suggested it could hit 100. I said, there's no chance. Maybe it goes down 5%. The stock's down 19% since then. This has gone down more than what I had expected. And so as just a starting point, people were bearish. You were, I think, had just more of a clear vision of how steep this slope was going to be after those delivery numbers come out. But here we are standing in front of the earnings. And I just want to put some context. And it's hard to know what is investors' mind and what's on analysts' minds. In terms of analysts, based on the FactSet numbers, the deliveries, the street is still looking for 5% growth in the June quarter. And if you take their current or the delivery numbers in their March quarter and grow them sequentially 10% per quarter, which is, I think, optimistic to do that. But if you grow them 10% per quarter, their deliveries will finish calendar 24 down 6%. For calendar 24, the street is looking for 5% growth in deliveries. Revenue, the street's looking for down 5% because they've had this ASP compression. But the biggest picture here, Dan, my take is that numbers are coming down going into this. As a shareholder, I'm bracing, and I don't know where the bottom is on this. And I'm bracing that this is going to be an ugly few quarters here, because if I'm right and we have negative growth, there is a question about what's the profitability ultimately going to be, which is, we can talk more about that. But the biggest picture is, I don't think it's priced in. It's every time you think it's priced in, it's never quite priced in, but I'm pretty sure numbers are coming down after they report their quarter.
It's interesting. And again, this has been evident. I mean, over the last year or so that you've seen this margin degradation. You've seen a lot of folks lean more into the other stuff, whether it be robo-taxi, whether it be full self-driving, whether it be Optimus, like the list goes on. And I remember, and again, I'm just going to name him. I don't know him. I'm sure he's a perfectly good analyst, but Adam Jonas at Morgan Stanley, I want to say it was like 6 months ago, put out this big report and justifying his, bull case scenario. And it was all about everything, at least the way I recall it, all the other stuff away from making EVs. You know what I mean? And to me, that was it. This is a big house that owns a lot of Twitter debt, okay, on their balance sheets. And I was like, enough already. And when I think about Elon Musk, and you know how I kind of feel about him, is he might be the genius that everybody thinks he is who owns this stock, except for the fact that he's running 5 companies at once. Do you know what I'm saying? And when I think about almost every single move that he has made at Twitter over the last year and a half, and almost every big strategic move he's made regarding Tesla over that same time period, probably going back a little further, has been wrong, flat out wrong. And so to me, he's stretched too thin. He makes very irrational decisions. And so if there's a huge premium in Tesla right now because of Elon Musk, I think something's got to give at some point. You know what I mean? With this whole situation. And then one last question I have for you is the debate over, there's a shareholder meeting coming up about this 2018 pay package, whether he should be awarded, $60 billion, maybe even more or something like that. Look at where the market cap of this company is. What shareholder would say that this guy deserves 10% plus of their market cap right now for all the decisions that he's made since 2018? And I get it. The stock's up a lot since 2018, but it's also down about 65% from its highs in 2021.
So maybe starting with Elon and just some perspective, and he's flawed. I'm flawed. There is a piece that, as far as, is he right? Is he wrong? The piece that I appreciate about him is he does not shy away from innovator's dilemma. And I think that that is a trap for a lot of tech companies. He is willing to flush current businesses. Look what he's done with Twitter, what he's talked about, a razor blade model with a car getting to autonomy, talking about shifting away from the Model 2 to a driverless. There's a piece of that I just appreciate. He's going for it. And I think in a world where we have these big tech companies that play at the margins, small businesses that they're making investments in, there's just something I appreciate about that. That's one piece. As far as, what the right valuation for this is in the near term, I don't know. I don't know how low this can go. I do believe that electrification is the future. I think that Tesla, what they've done over the last 3 quarters and embracing that versus traditional auto, I think that is a competitive advantage. I also believe in autonomy, and I'm not making a comment relative to FSD and autonomy. Lawmakers are a big roadblock to this happening, but humans shouldn't drive. Too distracted. 42,000 people lost their lives in 23. In 2013, when cars were not as safe, in quotes, 37,000 people lost their lives. So we're more distracted than ever. And when I see a company that's willing to embrace a future around autonomy, I just get excited about that. As far as the pay package is concerned, I think it's pretty hard to get that pay package past investors, given what's happened with the stock right now. I'd say a much different story than if the stock was 50% higher. That'd be easier to get done, even though the numbers would be more favorable to Elon. So um, I don't know. My guess is it gets pared back.
Yeah, and just really quickly on Elon, again, like if he is the genius that many folks believe him to be, wouldn't it be amazing if he just focused all that genius, whether it be getting us to Mars or really executing on a kind of mass market EV that is literally going to be the stepping stone towards robo-taxi and all the
There would
development
be.
that would go
He
on
won't do it
with
though.
AI? I know, but what I'm saying is like, that's how he's going to leave his mark, in my opinion,
I
because
got you.
you
Yep.
know what I mean?
Yeah.
Like that.
Focus on one and really crush that one thing.
Yeah, like that would be my take. But again, like it's like the true believers, like is all the really optimistic things that you had to say about Tesla. You don't own it right now, do you? Like you know
I
what I'm saying?
do
Oh, you
personally.
do.
I do
Oh,
own it.
okay. But again, you know what I mean? Like, I don't know if it went to 100, just think about that from here. You know what I mean? There's another
It's painful.
30% to the
It's
downside.
yeah. I think it is. And that one other piece, Tesla. It unfortunately, it's like crypto. There's a religious component to
Yeah.
this investing.
Yeah, no, I got you. Okay, let's talk a little bit about Meta, because this is the company that got religion last year. Kind of you and I have talked a lot about the metaverse and the move that this company made in 2021 into 2022, and 2023 was the year where, listen, I give Zuckerberg a lot of credit, because I mean, talk about doing an about face. I mean, what a kind of face plant that was. Change the name, change the direction of the company, but then pivot again. And there's a lot of excitement about this open source large language model that they've been building. They're rolling it out, at least some of the functionality across, their kind of suite of apps, including WhatsApp and Instagram and Reels and the Blue Page and everything like that. And it's getting some good reviews. And it's amazing that Elon has made Mark Zuckerberg, one of the prior villains of this kind of whole Web3-ish, not Web3 in particular, but, like really that kind of gateway to where we are with generative AI, making him look like a genius here. Thoughts on this one coming in? Because I wonder if it's a not too different setup than Netflix coming into the print a little bit. It just seems like there's a lot of enthusiasm, a lot of positive sentiment about it. The company has really had a lot of tailwinds because of maybe some of those comps and a lot of those cost cuts and the like. I'm just curious how you're thinking about this one into the print.
I think there are a lot of similarities between in terms of where the comps are at and kind of the tailwind that's happened. I think the biggest difference is that the benefit that Meta is having related to AI is more tangible. You outline that, and I agree with that benefit, and I think that will get progressively greater. One of the pieces that's been remarkable is that Meta has increased measurably their investment in the Reality Labs, the metaverse experiment, from call it around 10 billion a year investment to now above 15 billion over the last few quarters. So call it a 50% increase. And the stock continues to go higher. It's up 26% this year. And so that is how good the ad business is it's so good that investors have looked past something that is really bad about how much they're spending on the metaverse. And that does set up for an air pocket. And we do own in our flagship Titan product, we do own Meta. We've owned it for a long time. And we're also like, I'm bracing out, like I'm gonna be under my desk when the Tesla numbers hit. Probably will be standing by my desk when Meta comes out. But I think that this is kind of ripe for that. If you're curious, the street is expecting a deceleration. I'm just going to look at the numbers here. They're going to grow in December. They grew at 25% revenue growth. The street's looking for 26 in March. Calendar 24, it's 17%. In calendar 25, 15. One last piece, it trades at 24 times 2024 earnings, 21 times 25. And so I think that if you look at the 25 numbers, there's, I think, more support than like what Netflix had. And this comes down to this company it's had a lot of success. When you typically have this much success, and 2 quarters ago, people thought the stock was going to pull back. We're due for a pullback on Meta. I don't think it changes the outlook.
Yeah, and again, there's a huge gap because last quarter when they reported Q4, the stock went up 20%, making new 52-week highs. And when you think about that year-over-year deceleration, maybe that's the thing. There was an analyst, and I don't have all the detail, who downgraded, the big six tech names, and that was one of the premises, just the kind of difficult comps from 2024 into 2025. And as investors, as we get closer to mid 2024, they're going to start really focusing on 2025 and that sort of deceleration. But to your point about the revenue deceleration, it's just not that significant for a company like this. And again, I'm looking at the gross margins here, even with all that spend back in 2022. And now what you're talking about is actually the increase in spend for, metaverse sort of spending. I mean, it is pretty impressive that they're getting some of the benefit of generative AI for their own ad product, right? Which is masking maybe some of the, kind of negative impact of that spend. And margins, when they got hit 2022, they were down like 2%, like they went from like 81 to like 79 or something like that. And they've gotten back to kind of like above 80, and they just seem to have been flatlined over the last, year or two. Is that something that you're keeping a close eye on? Because again, that guidance on spend is the thing that maybe a lot of investors will probably kind of recalibrate some of their, again, it's the cheapest mega cap tech stock at 24 times, or maybe it's right in there with Google.
Right in there with Google. The spend, if it has the right language around it, I think investors are going to look the other way. And of course, we know what language that is. And so I think if they position this right, then I think that people would be okay with that investment. We're going to see that when we talk about Apple. We'll talk about their investment in AI that they haven't talked much about. The benefit with Meta is that they have talked about that. And so it's going to be a pretty quick turnaround time on that ROI. We're talking a matter of a year would be my guess. And so I think that's all part of the negative near term. One other piece on the long term that we haven't talked, or you mentioned Llama and the most recent model. Zuckerberg, of course, has famously said his goal is to build products that have 1 billion users or more, and then figure out how to monetize it. And in this case, he is a long ways away from 1 billion users with Llama. We're talking about tens of millions of developers use it. But the opportunity for them to create a subscription-based business or an AWS type of a business around Llama, I think is something that is potentially an unlock in terms of valuation and largely not appreciated by investors right now. What are they going to do with Llama longer term? I think that is going to be the thing you're going to hear. The most incremental piece to the Meta story over the next 12 months is going to be more focus on Llama.
Yeah, and it'll be interesting to see if they're actually able to roll out some subscription products. And again, this is something that, I think a lot of Meta like users, if you're a consumer and you use their apps, you realize that they've never been really charging you, like on Instagram, there's some kind of verification and stuff like that, but it's probably, I'm going to say low single digit percentage of users, Gene, right? And so for now, the benefit is just what they get of making better products, stickier, better return on investment for advertisers and the like, right? And therefore, like that's probably the angle. But to kind of, if they really do, if Llama 3 and some of the reviews have been really good, is stacking up there against some of these other, whether it be, OpenAI or some Anthropic or something like that, some of these other models, like at least they're in the game here, right?
Yep.
And so
look, OpenAI, if I can just put some context around this, when they did the Microsoft announcement in January of 23, they were essentially pre-revenue, like sub 50 million a year in revenue. Within 12 months, they were above 1 billion in revenue. So these can take off fast.
Yeah, no doubt. All right, let's focus on Thursday afternoon. It's going to be Google. This is one that was definitely a bit of a laggard relative to some of its mega cap tech peers. We've talked about it over the last few quarters, just kind of the initial release of Bard and then the rebrand to Gemini and then the release of that. I mean, they just haven't gone particularly that smoothly here, but some things are kind of happening. It feels like under the surface, the stock made a new all-time high, which is something that had been a little bit elusive. The sentiment was so bad for so long relative to Microsoft, OpenAI, maybe some of the stuff that Amazon and Meta were doing, but it seems to be that's kind of changed a little bit. Now, I want to just make one point. It's like, so the sentiment doesn't seem that negative right here, Gene, but over the last couple quarters, they've not been particularly smooth and the stock has sold off fairly dramatically. So this is a tricky one, in my opinion, relative to some of the other names we've already discussed.
It is, and this is Titan. Our flagship fund also owns Google in it, and this is one we've been frustrated investors just given I think the pace that they've been pursuing the opportunity in AI. I can say as someone who uses multiple generative models multiple times a day, I am freaked out about the what the potential could be to Google's search business. And I'm as equally as I'm freaked out, I'm even more optimistic that they're going to be able to crack that code. But that transition, like we talk about AI all the time, and it's I think important to take a step back. Most people actually don't think about AI. Most people know a little bit about it. They probably have heard of what an LLM is, and they haven't really used a generative tool more than once or twice. If you're a high school student, that's something totally different. You're using it every night to do your homework with you. Good news for them. But if you're a regular person, then this is something that is still just off in the distant. The reason why I mention that is Google's the behavior around searching with Google is so ingrained. They do have some time here. We'll call it a year to really help that handoff. And I think when the current Google search in the lab, they have it in the lab, you can use it. It's in their lab that's available to the public. Once that starts and that they have a search that's integrated with Gemini, as that starts to become more and more the default search, I think you're going to see investors get more optimistic. As far as this quarter, I have no idea how it's going to play out because I think that their search business, I'm just looking at the growth numbers here. They grew at 14% in December. The street's looking for 13 and 11% growth. Not too exciting growth numbers around this because we're still in this pre-inflection point to what the benefit of AI will ultimately be on their business.
Yeah, and it's interesting the search thing because again, I think it's really helpful for you to suggest that using all these other models, as somebody who owns Alphabet, you are freaked out, to use your term, about what it means for their core business in search. And I just went to Google and I just put in baseball gloves for shits and giggles. Okay, you know what I mean? And a bunch of sponsored blue links are the first things that I see above the fold. That's it, Gene, right? And so that's what they get paid for, right? And then if I go lower and then I go and I just start clicking on some things that are maybe better suited for me that are not sponsored, that sort of thing, like maybe understanding some of my behavior. Like if Gemini is going to have a co-pilot and it's going to kind of guide you and it's going to learn a little bit about that and it's going to be delivering me something that's more useful to me, I guess the question is, it's going to cannibalize that really good business that they've absolutely dominated. So if they are okay with cannibalizing themselves, how do they make that back up? Because there's not going to be tens of millions of people subscribing, I don't think, on a monthly basis to Gemini. Is that fair to say?
It's less about the subscription piece of the business. The way I envision this happening is similar to what happened when Facebook went public. Originally, when they kind of started out that the being a public company, there was some concern about the shift from desktop to mobile because the monetization was different. And they actually had a deceleration in revenue growth as more usage kind of shifted over. And that created an air pocket and the stock was down 50% after that. And then once they showed that they could monetize, this is when they came out with stories, they showed they could monetize it, the revenue growth followed. And I think you're going to see a similar type of a transition when it comes to Google had something similar too when it went from desktop to mobile. The monetization on mobile was lower, usage was higher. The way I envision it, it's less about people subscribing to Gemini, even though that is a product. It's more about how they integrate generative AI into the search experience. And so right now, the way I envision, and I think that there is going to be a trade-off there in the monetization. Just to give a real specific example, if you were I'll give you a search term I did over the weekend. Is I wanted to know what the best wild grasses were. So I went into Gemini, Anthropic, and Claude, and GPT. Asked for the best wild grasses for that do well in central Minnesota that can grow 3 to 5 feet tall, and they all kicked out the types, the species, and then I asked where should I buy them. And this is the problem that happens with Google is there are no blue links there. It just says, here's some recommended sites. And it's telling you the truth. And how this is the piece I don't understand is when the model is just telling you, here are the top 3 websites to go to. How do they change that into a pay for model. There's got to be some way to figure it out. I'm optimistic that if it becomes you have to be sponsored to get into that result, then people won't trust the model. They'll think it's a pay for model. And so they've got to somehow balance that out. I don't know what the answer is to it. And it is part of the risk. It's one of the reasons why Google trades at a discount to some of the other mega cap.
Yeah, and I guess the issue here is that, Bing, Microsoft, using OpenAI is going to have that same exact issue, except that Bing is, single digits percentage of search right now, and it's not their core business. And so
they don't have the innovator's dilemma that Google has.
Yeah, no doubt about it. So, it's funny. I give some thought to all of that too. And, listen, the last part of this is that all of these LLMs are going to become really commoditized. So if you don't have multiple businesses with, a billion users or and the like, and figuring out different ways to kind of monetize this or create a richer experience of the platforms that people are already, whether they be paying for, you know what I mean, whether it be Microsoft with Copilot and, making, users that much more productive and the like that's how you can justify, I guess, the investment that they've already made, right, in that. I mean, I don't think, I mean, is that fair or no?
Yeah, well, so why are we still, if I'm seeing all this stuff happening and I'm freaked out, why are we still owning it? We own it because we have a belief that there will not be, the models will not be commoditized. We think that training data will becoming increasingly important. If we look at, we're still a year and a half in arrears when it comes to training the biggest models. And eventually that training data needs to get more real time. And so, the types of data that models are trained on today is going to be different than in the future. And I think in Google's case, they've got a breathtaking trove of search data that when they start training their models more often, I think more often being on a weekly basis versus every 6 months or 3 months, that I think is going to be a competitive advantage. So I actually believe, just like in search, the reason why Google won is just was a better search tool. And Yahoo, I forget who, I tested my history of the internet here. I forget which was the original engine behind Yahoo search, but eventually it was powered by Bing. I think there actually will be some distinction, and you do see it in the models today. And so, and why do I believe that there'll be a distinction? Is because I think there are going to be wars around who gets what data to train their models
But
on.
by the way, Gene, it was Google, and 20 years ago, Yahoo did a deal with Google. They just ceded search to Google.
I was thinking, where did Lycos fit into that?
They might Lycos was really just like a search engine. It was like a portal in a way, which was a different terminology in a way. But Excite, Lycos, remember the like here?
By the way, most of the listeners never even heard of these.
No,
so,
I know. I thought Lycos was a fun little portal, internet portal. But it is interesting when you think about the fact that Microsoft then turned around and tried in 2008 to buy Yahoo for $45 billion.
That's right. I forgot all about that.
A company that was sold to Verizon for $5 billion. Now, obviously, Alibaba was a big part of even the valuation back in, maybe it wasn't that big of a part of the valuation.
Still, by the way, Yahoo in Japan is still a big deal.
Yeah. Well, so that was always the thing. And you were covering the stock, I guess, 10 years ago. I mean, the sum of the parts between Yahoo Japan, Alibaba, the stake, and then what their core business was here. But, again, Apollo bought Yahoo out of Verizon a couple years ago, and they have a lot of high hopes for that. Jim Lanzone is running that sort of thing. He is running that thing. He's not sort of running that thing. So again, I mean, I don't know if we've heard the last of Yahoo. How's that, Gene?
Oh man. So that's a mic dropper.
Yeah. So last thing on Alphabet, on Google here. So the last quarter, the stock was down 7.5% after the print, and the quarter prior to that, it was down 9.5%. And that's had really nothing to do with expectations in and around Gen AI. It really did have to do how the core business is performing. What are your expectations on that right now? I just don't see them guiding. I mean, maybe there's something in GCP or something that relative to Gen AI that gets people excited, but what in general about this quarter are you optimistic about? Do you think that stock's at 157 right here. It's very near an all-time high, trading at a multiple that seems very cheap to many of these mega cap tech peers, aside from maybe Meta. Is this one a pretty decent do here? Is a good hold if you're already long?
So I think it is, and ultimately, the near term, the piece that's going to matter the most is probably going to be around search again. And there is a macro impact. Let's call the macro relatively stable. There is a negative headwind. We didn't talk about it much with Meta, but some of the Chinese spending on some of the U.S. These social platforms, and it can have an impact on YouTube, for example. The street's looking for a like flattish quarter on quarter for YouTube. So I think that if search comes in that 10, 11, 12% growth, just showing that it's stable despite all of the fear, and that's what we're entering is a fear. And I would just remind you, if I'm dead wrong on what happens with AI and Google, the tail on their core search business is going to be long. Just remember Redbox. Does that one ring a bell? That business should have gone out of business forever ago, and it just keeps kind of hanging on. So if they show, I'm not suggesting there's any correlation between those, but my point is that there are transitions in tech. Even with AI, it takes a long time, and so I think that if search comes in and it's solid, and investors can say, "I can sleep well knowing at least for the next 3 months, the search business isn't going to start to decline," then I think the stock goes higher. I'm not making a call on this quarter, but my general sense is that there's just okay numbers are good enough for Google.
Yeah, and I'll just say this is that I think all of these numbers we just kind of talked about. There was a gap in Netflix. There was a gap in Meta. If these things were to kind of fill in those gaps just based on broader market action against sentiment that was just too positive, let's call it a month ago. You know what I mean? Had something to do with the macro, with rate cuts and the like. Kind of helping the idea of some of these valuations. And like, if you were to get like a 10% peak to trough decline like we had from the July highs in 2023 to the October lows, many of these names that we're talking about right now, they sold off more. They sold off 15%. It wasn't an indictment of their businesses or anything like that. It was just like, if they're all the alpha in the market, you should expect them, right, to be down more than the market. So to me, I just think that if, a Meta or a Netflix were to fill in those gaps from January, and the market gets oversold, you know what I mean? Like, it's probably not a bad place to start picking at them. And the same thing goes for like an Alphabet. If you find this thing down, let's call it 10, 15%, it's trading back at, below 140, 135, you probably want to buy it. And like, so to me, I don't think some of this is that hard. And you might say, well, you've been fighting this stuff for a bit. Well, part of it is because it feels a bit euphoric here, and it wouldn't take, Apple, we've already lost. Tesla, we've already lost, right? So when you think about a name like Netflix wasn't in that thing, some of these like SaaS names, have you checked that? They act horribly in this market right now. You know what I mean? So there is a lot of enthusiasm. If you don't have a great Gen AI story, you are not getting the benefit of the doubt right now, and that's a fact. So if Microsoft were to let's get to Microsoft Thursday after the close. If there is some sort of deceleration in the core business, we're seeing, let's say there's some weak enterprise spend. I mean, listen, make no mistake about it. When Tesla cuts 10% of their workforce, you tell me how many licenses of Microsoft products are going to get cut, right? And I know that that's not a huge number as it relates to their core, but if this is something that we're going to see, let's say in the back half of 2024, more cuts like this, right? Then ultimately it's going to be a knock on enterprise spending. And you could say, well, like, look over here at Gen AI and look over here at Azure, the cloud, and this and whatever. I mean, ultimately, like, you will see some sort of decel, and just the slightest whiff of that is the thing that takes the stock down 5-10% over a couple of weeks, in my opinion.
I agree, and I think that this one is one that the least optimistic about in terms of the greater opportunity. Obviously, AI, they're going to have a benefit there, but just specifically to some of those tough comps points is that we've seen an acceleration in Azure. Of course, that's a critical point. It's gone from 26% back in September to 29%. The street's looking for 28% growth. And then for full year next year, let me just quick pull up the number. Is actually don't have the 24 and 25 numbers, but it's 28% in the June quarter. So basically unchanged from where we are, 29% in March, that they're going to report 28%. But eventually those comps, the probability that growth that starts to slow is relatively high over the next several quarters. Just like with Netflix, probability that subscriber ads slow is relatively high given all the benefit that they've had. And so my general sense is that They're doing a lot of good things. There's businesses that don't get a lot of attention. GitHub, for example, we just did a ton of work on GitHub. I mean, this is used by developers. If you're building software at a larger company, you're using GitHub. You've always used it. You're not turning it off. You're going to use it more with AI. There's a lot of examples with Microsoft, but big picture is that this is a great company, but just has some, what I think will be some generally declining growth rates. The street's looking for 15% ish this year and 15% for pretty much the next couple of years, pretty much unchanged in the growth rate. And there's probably a little bit of risk to that in out years.
Yeah, and when I think about this, so 15% earnings growth, 15% expected sales growth, flat margins in and around, let's call it 69%, trading 34 times fiscal 2024. So that we're kind of pretty much through that, and then fiscal 2025 about 30 times. It's expensive, and so that's kind of my only point.
Thank you.
Yeah, is that if they do guide to a decel, like a little bit more than what the street expects, it's going to take a couple turns off that. You know what I mean? So like that's the thing. It's down 7-8% from its recent all-time highs just in the last month or so. I mean, could you see another 10%? Sure.
Yeah. I'm just looking right now. Microsoft's trading 30. I'm showing it 30 times 2025 earnings.
Yep.
Nvidia's 26.
Yep. Well, I mean, listen, but that's the other point. We'll probably save NVIDIA for another pod because they don't report until the end of May. But when you think about the concentration in basically earnings and revenue, okay, from Microsoft, Amazon, Google, and Meta for NVIDIA, if all of these companies, let's say, were to sell off, all these stocks were to sell off because estimates that, like don't come in as high as the street expects, well, then NVIDIA is going to sell off too. You know what I'm saying? Because that's like the easy one to kind of extrapolate for. But again, I'm one of these guys where a few weeks ago, I was very, kind of pessimistic heading into Q1 earnings, and given like just kind of some of the macro and where the dollar is and where yields are and all that sort of stuff. But now a lot of these stocks have sold off, and I don't think they're great presses. Like you have to get the story really right from here as it relates to the guidance if you're going to be pressing Microsoft down 8% or something like that into the print on Thursday. Does that make some sense to you too?
It makes some sense too. We're kind of going through this whole downdraft in the market started with a hot CPI number a few weeks ago. Obviously, there's been some specific fundamental things with like Tesla, for example, but the real downturn happened related to rates. And I think that, we'll see the numbers, we'll see the quarter, and ultimately, I think tech investors are going to take a step back and ask your question is, what's your conviction in the pace and the transformation rate of AI? And I suspect that the commentary we're going to hear on the call, we haven't heard from Apple. They're going to talk about AI on the call. I think that the pace of build out, the pace of optimism around AI, I still think we're scratching the surface. I sound like a broken record. I think we haven't even started. And ultimately, in terms of how they respond to this quarter, we're going to see some up, down. But most of the companies that we've talked about today are going to have a nice tailwind for the next 3 to 5 years.
Okay. Let's talk about Amazon. This is Tuesday after the close, April 30th. The stock has actually, done really well. As far as generative AI, they've just been kind of making investments. I know that they've been spending billions on machine learning for, like over a decade. We know that they benefit from AWS and their exposure there and the use of all of these models, by lots of different, different sorts of entities, who all basically, like some way, shape, or form, unless there's very few folks on the enterprise level that are just exclusive to one public cloud, correct? Right? So like these guys should benefit. We know that the growth rate has been coming down. They've been losing some share, right? As Azure and Google Cloud have been playing a bit better in their sandbox. Thoughts on Amazon into the print, because here's a stock that has performed very well over the last few quarters. There's been good margin improvement, right, as we've seen over the last couple of quarters. Thoughts on this one, because again, this is one where I just think that, people feel like for the first time in a while, they can justify this always rich valuation.
Yeah, that's took the words right out of my mouth. Is that it trades at 33 times 2025 earnings. Usually Amazon's like 80, 100, 150, not meaningful times earnings because all the ups and downs on their margins. I think the most important piece, as you talked about, is going to be AWS. It grew at 12% in the September quarter. It had to grow faster. It grew at almost 13%, like 12.8 in the December quarter. So let's call it going from 12 to 13. The street's looking for 15%, 14.7 to be exact, percent growth in the March quarter, and then 16% in the June quarter for AWS. And so that is, now granted, it was growing in the 20% a few quarters ago, but they got to nail that. What's the probability that they get the 15? If I was going to take the over under, I'd probably say it goes under. I don't think they quite get to the street numbers for the March quarter when it comes to AWS. All the other mojo that they have around building AI, robotics, and the fulfillment distribution, and actually seeing a decent margin on retail, all that hope longer term is still in play. I think that they've got a big opportunity there. But this, unfortunately, is all about the AWS growth rate in March and their commentary about what it's going to be in June.
Yeah, it's pretty fascinating, Gene. When you pull up a 5-year chart of Amazon from its COVID lows, it went from the low 80s to 2021, the highs mid-year, like the week that Jeff Bezos handed Jazzy the reins as CEO. Okay, so the stock was up basically $100, okay, in a little more than a year, and then it spent the next year and a half going from basically 180 back to its COVID lows. Like, just astounding, right? So here we are now. 2 weeks ago, the stock made a new brief all-time high, in the mid 180s or so. I mean, it's just like absolutely insane. And then you say to yourself, okay, like, what do they have to do to break this stock out, you know what I mean, and meaningfully go above those prior highs? You would need to see, to your point, a reacceleration and the confidence that you're going to get back towards 20% sort of growth in AWS, right? That
Right.
these investments in Anthropic and the like. And then, you're starting to hear more and more good stuff about retail pricing power and the operating margin improvement there, right? And then, a year ago, you could have made the argument that the North American retail business, you're getting it for free, or that was part of the argument, like, you know what I mean, a year and a half ago or something like that. So again, this is a tough one, aside from the fact into the print that it's just sold off 7% or so.
I agree. And again, I think it's about AWS. I think that's going to show some improvement. I don't know if it's going to show the level of improvement that investors are looking for. Doesn't change, I think, a massive opportunity that the company has in building AWS higher for longer, and separately what they can do around margins in retail.
Yeah. All right. Last one here before we talk a little bit about TikTok. But Apple reports, I think it's next Thursday after the close. And, this is one where, you just mentioned you're expecting maybe to hear a little bit of generative AI. I really feel like until they have a big announcement, there was a month ago, the Wall Street Journal was reporting that they were talking to OpenAI. They even threw Baidu in there, which was crazy to think about, like how that name that, they're talking about different models.
It makes sense though. That's the crazy. It does make sense.
Yeah. But I mean, like when you think about TikTok is about to get banned in a bipartisan bill in the US, or a forced sale. And if not, it's banned.
The Baidu would only be in China though.
Yeah, well, okay. I mean, like, again, that would make sense for their users in China, because the likelihood of being able to use one of these models over there. So I get it. Just the fact that name was bandied about.
Yeah, it does. I mean, it definitely causes you to double take, no doubt.
Yeah, and again, and their iPhone sales in China are down double digits year over year, right?
That's
and
bad, yeah.
So like to me, I just would not want, if I'm their comms people, I don't want Baidu mentioned right now. You know what I mean? Like I want as little conversation about China as possible. You think about this iOS installed base of 2 billion users, they got to focus on ex-China, in my opinion, right now, because China is a dead bang losing strategy for all the lobbying that goes on here. You know what I mean? Like, and Tim Cook has obviously spent his share of time over there in China. It just seems like right now, as they're diversifying away from Chinese manufacturing, I want to kind of de-emphasize that a little bit, I guess. I don't know.
For sure. I can put China quick in the context here. The China business is called just under 20% of business. In the June quarter, it was up 8%, June 2023. In the September 23 quarter, it was down 3%. And in December 2023, it was down 13%. So we've seen this slide. The first 6 months of data, third-party data, suggested that the China iPhone business, which is a good comp for the overall business, was down 24%. BYD was down big in the first 2 months of the year, and then it skyrocketed in the March quarter Obviously, cars are very different than phones, but we could see a bounce back. Either way, they're probably going to miss on. China's probably going to be down by more than 13%. It might be down by 10, might be down by 15. It's still going to be an ugly number, to your point. I went and did the math. This surprised me. I wonder, what if you backed out China over the last year? What would Apple's overall business be? And the answer is, with China in it, Apple's business over the past year is down on average 0.6%. If you take China out, it's down 0.1%. So it's still bad. Apple still has a growth question. Now, I own the stock, and I believe that they're going to say some things around AI, and we can talk about all the waves that can build off of each other. I also believe that the Department of Justice is off base. It's going to take, of course, years for it to figure it out, but I think this is going to come out to be no, or a little of no impact on their business. So I'm still optimistic about what they're going, but I think that the core question around Apple is just get me back to growth. The business hasn't grown.
Yeah. And isn't that sort of a product thing too, in a way? I mean, just think about your own usage, of like the iPhone, which is what, 50% of their business. And, you're just not upgrading them that much. The phones aren't that interesting. And even if they were to have some generative AI model built into the phone, and that's really probably what gets announced, at some point in early June at the WWDC, it's probably not going to be in the 2024 September, October release of the high-end iPhone. You know what I mean? There probably is going to be some like slick software sort of thing that they have to license and quickly integrate. But this is not a company that has done a great job, if you just think about over the last, call it 10 years or so, with, integrating some of these software services that they developed. You know what I'm saying? Like, and Siri is really, I think, the best example, but you could go back to the Maps fiasco and the like, and I get it. Services is a huge part of their business, okay? But those are third-party services, a lot of them, and the toll that they take on that, you know what I mean? So to me, I don't know how they differentiate from, I was with a couple guys this past weekend who had brand new Samsung AI phones. Well, it's not really an AI phone, do you know what I mean? It's just marketing.
Nice branding.
Yeah, it's good branding, but like I just don't see a big catch up anytime soon. Do you? And again, they don't need, like, they clearly didn't spend any time or energy building an LLM. You know what I mean? So the idea now that they're going to build one, get it all trained up, integrate it into their ecosystem, that would take like 2 years. You know what I mean, or something like that. So,
They might, I mean, to your point about some of the rumors out there, is that they may very well license Google or OpenAI's LLM for at least the near term. But I think that we will obviously see more. I think the initial explanation or initial use cases we see in June or at WWDC are probably going to be around just using generative AI and text and email and kind of and Siri, making Siri better. Siri's not conversational now. GPT is, Siri's not. That needs to become that. So these are kind of all steps to what ultimately is my question is not what are they going to show at WWDC, because I think they're going to show some bells and whistles that we saw a year ago from Google and Microsoft. What is more important is, can they start to paint the vision about, or will investors start to read into where the vision is around what they can do in this agent-based AI, where they can actually do tasks? I think that is a unique place, just given where they're at related to privacy, for Apple to have an impact and have some products that would be exciting. Not just tell you about what would be a great place to go, but actually help figure out little things in your life. And so I think that's the bigger opportunity. I do want to mention too is that this comes at a cost. Apple's they missed it. They missed AI, and they've realized that. Missed generative AI, just to be specific, and I suspect we're going to hear about increased spending on this earnings call. Now, that could come at the cost of margins. I don't know if investors will care, because they've been so slow. You could see a case where people applaud that, a declining margin, which is Apple's margins just have inched up over the last decade. So you'd normally think margins go down, stocks going down, but given how slow they've been in AI, maybe the opposite happens.
Yeah, the only problem, in my opinion here, Gene, is that in the intermediate term, I mean, there's not a lot of valuation support given the growth. If margins are going to decline, I'm just looking at it also technically, it's back to where it was at the lows in 2023 in this kind of mid 160s range or so. I mean, you're going to have a move back to 140, in my opinion. You know what I mean? And then maybe the stock looks set up because part of the problem that I see is that let's just say on June 10th they announced some big partnership with Gemini. They announced, that this is Alphabet, obviously. It's some sort of integration of their current search deal that they have, right, for iOS devices and software in Safari and the like. Here, they're just not going to be able to kind of ship anything that's meaningful, like to cause an upgrade cycle in their actual hardware, in my opinion. You know what I mean? Like that, because let's just say, how long would it take for Gemini to be integrated across all of the like the iOS sort of apps that come loaded? Because at the developers forum, they need to roll out, all the stuff and all the kits and all this stuff, and the developers start putting this stuff in there. It's just going to take a long time. You know what I mean? Like, so at this point, I don't really see anything that exciting being able to ship, for another year. And then the last thing I'll just say is that like this Vision Pro was like a really hot topic for like 10 days.
Yeah,
And then
no one's talking
it's
about it.
just gone away. You know what I mean? And so they've lost a lot of luster, I think, in developers' eyes and people who love the next hot whiz bang sort of thing. And so I just think that's going to take some time. To your point, you said they don't have a hot product right now. I don't think a licensing deal for Gen AI changes that.
I think that is a step in the right direction. I think they can show some functionality. I think it may be really easy, basic stuff to integrate it into Mail, for example. That's not going to get anybody too excited or make Siri a little bit better. But I think the point still stands is, what's Apple doing around innovation? I still believe that there's a place for spatial computing. Before Vision Pro came out, I talked about this year being the year for Apple enthusiasts and developers, and that they would sell a few 100,000, and that's what's going to happen. And so, I have the piece that's been disappointing for me is on the development side, because we have a venture business and we talk to startups. I was expecting to see more activity around startups who are building apps for Vision Pro that would get me excited that the use cases were starting to fill in. We haven't seen that yet. I still believe that it will find its way because I think that humans naturally gravitate to easy, immersive experiences. It's not a comfortable device right now. Big picture is, I think next year, if you look at 2025 numbers for Apple, the street's looking for 6% growth, up from 1%. And I think it's definitely good. They will have accelerating growth. I feel good about that. And for Apple, given what's happened over the last 6 quarters, basically being flat, I think a 6% growth would be viewed as a positive.
Yeah. Well, I'll put this one in the camp that if it were to sell off 10% from here, definitely given the relative underperformance over the last, call it, year or so, it's probably a good do in that 150 to 140 range to start picking at it for all those reasons you just mentioned. Is like getting their act together, generative AI, doing something in spatial computing, maybe having some kind of new hit, wearable, some sort of integration with some of the stuff that they have right now. AirPods, who knows, getting Siri right. There's a whole host of things that could go right for this company in the near term. I can't envision any of them over the next few months. All right, one quick comment, because I know that you've talked about it on Fast Money. Before we get out of here, TikTok ban. Okay, so basically this bipartisan bill that got passed, it's likely to pass in the Senate here. It's basically pushing for a forced sale to a U.S. company. If it's not completed by a certain amount of time, I think that time has been expanded. Initially, it was kind of drafted at 6 months. Maybe it's 9 months. There's going to be lawsuits. There's going to be a whole host of other things. It's an election year. I get it. But the fact that it's bipartisan right now, I guess Biden and Trump are on different sides of this sort of thing. What do you think the impact near term is to any of these companies that we've just talked about?
Well, I first want to say something to all the TikTok users out there. Don't panic. There's Reels. There's Shorts from YouTube. You got other options, but I think that the trend here, the trajectory is that this is going to be banned. And I think first and foremost, because I believe it should be banned. This is we can't obviously use Meta and Facebook and Instagram in China. Why should they use theirs here? It just doesn't make sense. But beyond that is the impact of the business. To answer that question is that TikTok's U.S. business is reported to be right around $15 billion a year in the last year. Now, the time spent, they have the same similar number of users, about 175 million, as does Instagram. So consider the user base the same. The difference is that TikTok has about 65% more time spent per day. And so they've got this trove they've got this time of usage that they're not monetizing as well as like Meta does. So to answer your question is that if Meta takes half of TikTok's revenue and they don't improve the monetization of it, which is, I think, conservative, that would add 5%, about $7-8 million to Meta's overall business. That would add 5% to the business. So it's pretty small in that context. If you think that they can bring that time spent up to a level in terms of the monetization, then it could add 10%. So that just gives you the context. It's a 5 to 10% positive swing.
Yeah, well, listen, I agree on the reasons why it should be banned, and a simple one, especially as we are in a massive sort of economic war, if you will, with China, with a whole host of different fronts. This one seems like low-hanging fruit, so I get it. Listen, Gene Munster, you are the managing partner at Deepwater Asset Management. You join me at least a couple times a quarter. This is pretty good, man. We do a little bit of a preview of big tech earnings. Let's definitely do a review. Check out Deep Tech 315. It's at Munster_Gene. Follow him on the Twitter and watch his videos. They're great in 15 minutes, 3 topics. Loving it, Gene. Thanks so much for joining me. I really appreciate it.
Thank you, Dan.